Good morning, everybody, and welcome to this week's weekly wrap. It's Friday morning. It's the 27th of February. My God, February's nearly done. And there's three of us on the screen. Anthony, Mirko, welcome, boys. How are we?
Good morning. It's I can see the easterly sun rising, Luke, above your head. It's just the light shining on you. It is pretty bright on this side of the building.
It is coming through, mate. Sometimes the future's so bright you got to wear shades, mate. Sometimes. So one of those ones. Remember that song?
I live by that song.
Anthony, how you going, buddy? You been well?
Good morning, Luke. How are you?
I'm going well, mate. I'm going well. Nice to see you in the office bright and early too, mate. Well done.
Don't be nasty. Don't be nasty.
He usually unlocks the doors. Let's be honest, Anthony.
Look. You know, it's always good time to take the Mickey out of people. Always good time. Mick, it has been a crazy week this week. Lots been happening in the world. We've had budget whispers. We've had State of the Union addresses by Donald Trump. We've also had the privilege of joining Market Summit this week, and we had an investment committee update as well. So it's been a big week from that end. But look, before we get into all those other things, how about a quick market update? Let's see how that's gone.
Yeah, quick market update from me. The Aussie market's actually been pretty solid this week, and we've had some reasonable data in the sense that the belief is that inflation rate actually stayed the same where it was. So the belief is that perhaps we're a chance for rates not to go up. I wouldn't be holding my breath. Inflation was still, at the same point at about 3.8 where it was. So I think that 3.8 through to January 2026 probably still too high for the RBA. So I would expect that there's still a pretty big chance that we get another rate hike at some stage. But I think the market will take anything it can get its hands on right now. And one of the things that it was happy about was the fact that it hadn't gone up. So it was sort of level and plateaued. But, I did read with interest that with the announcement that was made, one of the reasons that it had spiked up so high is that the government subsidies, we had some subsidies regarding electricity and whatnot, have now officially ended. And that actually drove electricity costs up by 19%, which completely blows my mind that that's the cost of power here. But I think that one of the things, speaking of power, we did have the market summit, and one of the speakers got up and spoke about the production of power around the world and compared the United States and China. And I thought this was actually really fascinating. So China's production is coming in at somewhere around 10,000 terawatt hours versus the US, which is sort of coming in about 4,300 terawatt hours. Now, you may be listening and thinking, what the hell is a terawatt? Well, I can tell you it's 1 trillion watts. So that's, if I'm correct, that is a one with 12 zeros attached to it. And China has really just forged ahead in this area. And they don't care how they get to it, whether it's nuclear, whether it's coal-fired, whatever the case is, but they realise how important power has become. And it may actually be their secret superpower in truth, going forward, having that much capacity, because everything that we do, we talk about AI and all that sort of stuff, it's all about power generation. So, the world getting left behind, and I think about poor old Australia here. We're still trying to scratch our heads, work out whether we need to turn our air conditioners down when it gets too hot. So, it's pretty sad state of affairs on the power front here, particularly given how resource rich this country is. But don't get me started on that, guys, because I could go for a while on that one. But look, market numbers themselves, the All Ords were actually up 1.1% for the week to date. So with Friday still to trade, I reckon we'll be a little bit softer today, but holding above this 9,000 level, which is pretty resilient by the Australian market. Reporting season's been pretty good in Australia, so we're sort of tail end now. And the big heavyweight miners, the banks, energy, they've delivered pretty good results and have been rewarded, as have investors. So a positive week for us here in the US. We've had 3 days of trading. so far, and we're off just in the red, just ticking off in the red. So still that discussion about the AI spend and whether that is going to be fruitful in the US, and that seems to be dragging down, despite the fact that Nvidia reported some astronomical result. The revenues were up 70% on last quarter, and still last night I saw that Nvidia came off in price. So yeah, plenty to unpick there, but yeah, like you said, Luke, plenty going on in the world, and we're constantly trying to figure out how to play this and what we need to do.
Yeah, no, look, it is fascinating in the markets at the moment, and the thing that's probably most interesting, Mick, in terms of the AI story is, whereas before it was like the tide, on a technology sector and anyone that was in the technology space, all the companies rose in value. What we're now seeing is that because of our AI and the advancements in that technology, certain companies now are challenging companies within the technology sector. So, someone like IBM before, which was critical for the banking sector to do a particular function, has now been removed from them, which was a major part of IBM's revenue. And all of a sudden, AI now can just come in and obliterate that from that point of view, which is causing IBM's value to come down. So, that whole notion of, that passive process of just as long as you went hard technology and you invested long technology, you'd be okay. What we're finding now is a discrepancy between the stocks. So it is really now about placement and so on, and we'll do more about that. But look, before we get into that, what the federal budget is in May, so we're still a couple of months away. We've got March and April to go, but silly season starts now in Canberra. The doors are closing. People are now having conversations, and we're seeing things appear in the paper nonstop and on the media nonstop. And the issues around the budget are really around cost of living relief. We know, the health and housing are major issues, energy transition, and productivity around the tax reform piece. The one thing that keeps on appearing continuously in the media is that capital gain thing. And there is this discussion around discounting or reducing the level of discount on the capital gain. And I know we touched on this a couple of weeks ago, but the drumbeat seems to be getting louder. Anthony, I guess from your point of view, if we go back to capital gains, maybe if you provide the clients or our clients with a quick explanation of how it actually works and how the discount is applied. And I guess if we go another step further is, what would it look like with a change, I guess, from that end?
Yeah, thanks, Luke. So effectively anything that's post September 85 is what we call a post CGT asset. And there was around about 2000 when they removed indexation and introduced the 50% concession. It meant that if you held that asset in a post-CGT environment for longer than 12 months, that gain, so effectively your proceeds minus your cost base, that gain could then be discounted by 50%. So you bought something for $100, sold it for $200 3 years later, effectively $100 gain becomes 50% concession, gives you a $50 gain. So effectively, it was wiping out a fair amount of tax. So effectively, your tax rate on your gain was going down to 25% at a top marginal tax rate level, roughly. What it will do now, or what they're proposing, and there's been discussion around whether indexation comes back, whether they remove the concession completely. I don't think that they'll remove it completely. I think some of the discussion this week has been about a 33%. So effectively, you're going to get a third off, which is similar to the way in which super funds currently work, where they receive effectively their effective tax rate is 10% as opposed to 15%. So it would align those two, which makes a little bit of sense. So it's still fairly generous, and I think the population would probably cop a 1/3 reduction as opposed to the complete removal.
Anthony, am I right to say that if it is a 1/3 discount from that point of view, that would, like at the moment, using your example of $100 profit, $50 set aside, worst case scenario is if you're on the highest marginal tax rate, you pay 24 cents on the dollar.
Yeah,
so that's what was happening now today.
Correct.
If we go to a third, does that mean the tax rate would effectively become quasi around 32, 33 cents on a dollar?
Correct.
Okay. And so you can see the logic of that, because if the government's going around, the majority of Australians are paying 30 cents on a dollar, we therefore then remove the tax avoidance argument, because people are buying assets for capital gain and paying less tax than what they would on income, in theory, because of the discount, and everybody now would be tarnished with the same brush. Is that a fair observation?
Yeah, I think that's right, Luke. But it opens up a whole discussion around, historically, you wouldn't buy assets or appreciating assets inside of a company because of the 30% tax rate. And it was always better to hold them inside a trust, a super fund, or personally, because of the tax benefit. Now, if they go back to this method, and effectively your effective tax rate at a top rate is 32 cents, then companies might become more appealing to be holding appreciating assets because the discount isn't as attractive.
Yeah.
So it seems like they're trying to get some alignment across all the structures. And as much as there's been talk about tax reform within trusts for so many years and changing that, I can't see that that's on the agenda until there's a case currently before the courts, Bendel, which potentially could change the whole way trusts are operating. So until that goes through the court system, I can't see that the government's got any scope to effectively touch that area. So this might be just a way of trying to realign the tax rates across the structures.
Yeah, and mind you, this also opens up, I guess, from an estate planning opportunity as well. If you think if companies now come back in vogue, whereas a trust has an 80-year time frame, whereas a super fund needs to be crystallised upon one's passing, a company is an ongoing entity. So from an estate planning tool point of view, wow, what a planning tool that could become.
Yeah, well, that's right. And it's the governments or various governments over many years have talked about trying to remove trust to bring everyone back to a company structure and flat tax rates, etc. This, when you sort of think about it in terms of what they're potentially trying to have play out, maybe it is this. Maybe it is that they're trying to just have a more unified tax rate across the entities.
Yeah. Well, look, whatever happens, and we'll find out in May clearly. But look, the challenge, I guess, from that point of view, is when you start to see it appearing in the media so often, you kind of move away from this is just chatter to it's starting to feel like it's a given. So there's going to be some sort of a change, I guess, from that point of view. Okay, just thinking ahead here, the challenge for the government is obviously the problem that we've got is they're talking about intergenerational wealth. So the argument would be, well, obviously, if we reduce this, we take more of a tax take. Do they take this money to help retire some debt, or do they take this money to perhaps build a greater buffer, particularly for the younger generations who haven't had such a massive win on the tax side of things? What's your view?
Yeah, look, I think probably not as well thought out, apart from what's the lowest hanging fruit in terms of tackling, the budget deficits and whatnot. I also worry about the flip side, and sort of if you remove these concessions, the incentives to invest may actually sort of be slightly constrained as well. And as we know, we've got like a housing supply issue across the board. So, this rental crisis that we have, and like, could that be potentially exacerbated by such changes? And so that's something that I'm thinking about. I don't know about you guys, but I've fielded a few calls over the last month, particularly as these sort of rumours have got stronger and stronger about people saying, should I be offloading my property now and whatnot? I don't think you can, make decisions on a whim like that and jump at shadows. And, there's obviously consequences and timings and the like. And realistically, if a change does actually occur, we don't know if it will be somewhat retrospective, if it might have a 1 July, 25 date on it, if it's pushed forward for 2 years. You actually don't know the answer to that. So making a decision based on what we, think may happen is a difficult one. So, the message has been pretty consistent to just sort of think about this, with caution. And like you said, if it drops from, to a 30-odd% tax rate overall, it's not the end of the world versus, selling an asset at the wrong time, and all the rest of it. So I think that, probably some more thought needs to go into that, because one thing that I've been super keen on, and one thing that is so frustrating to me, is that everywhere that business owners seem to turn, there seems to be more and more disincentive to invest. And I think that policies like this, whilst they could be short-term band-aids to the budget deficits and the like, the reality is that unless we have incentive for people to be investors and to deploy capital, you suddenly lose that entrepreneurship as a country as a whole, and that concerns me at a big picture level.
Yeah, yeah, and look, I hear you on that point, but I think you can also then distinguish that between is it passive capital or active capital. So your active capital argument of we're actually going out, we're building something, we're inventing something, we're delivering products and goods and services, whatever it might be. That could be treated one way, versus it's just a passive instrument where I've got surplus cash, don't know what to do with it. I'm going to buy a property, I'm going to flip it. That's a different outcome. So that's the thing where you kind of sit back and go, well, okay, how does that all work? Because I think one thing about the American system, I do think the American system's done this well. On the R&D and on those, on the ground, when you're coming up with an idea and you're developing this idea and it becomes a multi-billion-dollar idea from that point of view, the people who take the risk and all that kind of stuff are heavily incentivized and rewarded as a result of that. Whereas here in Australia, we're not. So I think there needs to be some sort of consideration or some separation between what is active capital versus what is passive capital, if we're going to go down that path. Since we've spoken about America this week, we had a speech by the president, Mr. Trump, in terms of the State of the Union address, which was, to put it bluntly, it was an hour and 47 minutes of sheer joy, depending on which side of the aisle you sit on, obviously. So if you sat on the Republican side, Donald Trump came out with his greatest hits, spoke about the big picture, spoke about the economy, telling the world that America is the hottest country at the moment. They are pulling in cash like you wouldn't believe. Life is fantastic. Everyone's doing well. It's party time. It's a bit like the scene in The Great Gatsby. 1920, people are dancing, everyone's having a great time. The thing that's probably missed in all this is the fact that maybe a lot of Americans don't actually feel that at this particular moment in time. The cost of living is starting to bite. And when we went through what Donald Trump said over his speech, there were a lot of bits where you kind of thought there's a touch of exaggeration there, or perhaps a little bit untrue. I don't know, gentlemen, did you watch it? Any views?
When we start weekly wrap, it quite often is the case we go, it is a weekly wrap. Let's make sure we don't go rambling on and it doesn't go for too long and whatnot. I don't think anyone had that discussion with President Trump heading into that, because it was a complete ramble of showmanship and how good am I and how good are we. And I'm just going to hit you with as many facts as I can, regardless of whether they're Fed income or whether I've just made them up on the fly. And it just got a sense of everything that's going poorly in the world right now. It was very much on display for that hour and 47 minutes.
It was. Ant, you got a view?
I had a Trump-free week, so I
chose you're happy.
You gotta have some time out from this man, otherwise, yeah.
I think clearly Anthony's planning a holiday to the United States, Nick, so we've got to be careful there, mate. So there might be
Anthony, your association with us will end you up in Guantanamo Bay too. Don't worry about it.
I'll just go visit him in Greenland.
Yeah. all I will say, look, I must admit, I sat down to watch it. I lasted about 10 minutes and thought, no, I'll just watch the highlights reel. I think, there is no question that the Trump administration has done some okay things and they've achieved some outcomes from an economic perspective, no question. The execution, however, is probably questionable the way they've gone about it. But the sheer divide between the twos and the polarization in that country at the moment between the Republicans and the Democrats and which side you sit on the aisle is actually quite frightening. And, it is teetering on a knife's edge in terms of where that goes, because you're looking this, we're not talking about political disagreements, we're talking about political hate. And that sort of language and that sort of approach, I think, is really dangerous, because all it takes is one lunatic with a gun and you've got all types of chaos occurring. And I think that occurred in World War One. And we're here again in terms of the stupidity of it all. Now, this week as well, on Wednesday, Market Summit, Portfolio Construction, happens on an annual basis where the best economic minds around the world come to Australia and congregate. and give their views about where they think the world is from a geopolitical perspective, where they think the economies are, where they think the opportunities are, where they think the risks are. It is a fascinating day always, and very high octane, and they do run a good show there. I must give Graham Rich and the team at Portfolio Construction some credit for that. Gentlemen, we're all on the screen, we're all watching it, we're all paying attention to it from that point of view, and having our inputs and questions answered from that end. Okay, what are some of the key takeouts, I guess, from that point of view, and what are the key action items from what we heard in the coming period, you think?
Yeah, look, it was a pretty solid day, and Market Summit 2026 was full of some really good content and a lot of sort of thought-provoking material. The theme of the conference was "It's a whole new world," and then in brackets again, and I think that that really resonates with the theme of, but this time it's different, and I think some of the speakers that we heard, we listened to things around contentious stuff around the geoeconomics, the geopolitics influence in markets, sort of different asset classes that we look at, sort of small caps, mid caps, global REITs, and we really had the opportunity to sort of dive deeply into what's actually happening in the marketplace. And I alluded before to this bit of a switch around the AI stocks and the sort of phenomena that's occurring there. And to give you an idea, one of the speakers got up and spoke about the spend in the AI space, and if you look at the big players like I rattle off some names: Amazon, Alphabet, Meta, Oracle, Microsoft, CoreWeave. Their spend, their capex expenditure forecast for this 2026 year is just over $700 billion on AI, and it is just extraordinary numbers. And some of these companies have actually been punished because of this spend, and then we're looking at the actual raw numbers, and then when you dive a bit further into this, you realize that they're actually spending this money out of cash flow. And there's some pretty intelligent minds, that are attached to these companies. So they wouldn't be doing that if they didn't think that this was a worthwhile investment allocation of their capital. But what we've seen on the flip side is that the market is literally just waiting for any opportunity to say, "Can't believe that Microsoft is spending X on AI, terrible decision," and the stock slumps, even though they're not borrowing money to do it or whatever the case may be. And we've seen sort of the downstream effects of software stocks getting belted as well. And one of the really interesting topics was the notion of the productivity. We always talk about productivity. We've mentioned it a couple of times already today, and what this could potentially do to the productivity of the world. But on the flip side, what sort of disruption could this actually cause in the employment space? Particularly they're talking about in the white collar area. Will people continue to have the work and the like? And I'll give you an example. I won't name the stock, but internationally traded company, software, accounting based, and have really got their act together in terms of being able to process do it yourself type tax returns in this case, particularly in the United States. And all of a sudden, and they're really far ahead of their competition. And all of a sudden, people have gone, well, maybe AI will be able to sort of enhance that. And instead of these guys charging, let's say, $100 for a return, we might be able to get it done for $20 using AI online. And so all of a sudden, software stocks are on the nose. So we have a great deal of stuff going on in the world on that front. And what I would like to say as far as action items and takeaways for us, and interesting that we also had investment committee yesterday. So we had our investment committee meeting. It was actually nice to sort of see the flow of that information that we saw at Portfolio Construction, how it flows through to our investment portfolios, and what we've seen is that we've taken a bit of a asset allocation view that we need to maintain our quality of assets, and that we can't get caught up in this, momentum, FOMO trade. And we certainly can't jump at shadows, because the way the market moves, and every week I get on here and talk about the numbers and the moves, and it's not uncommon to have a 2 or 3% move a day. So what we've said is that we need to maintain our discipline, maintain our look through on the quality of our assets, knowing well that they will be able to survive regardless of the disruption side of things, because they're just good quality companies that throw off massive amounts of revenue, that don't have a lot of gearing, borrowing within their portfolio. So it was a really good thing, and I usually end up rewatching some of this again, because you always pick up a few little sound bites that are worthwhile.
Right, absolutely, mate. And thank you for sharing that. Anthony, you also joined us for the Jonathan Payne session, and Jonathan Payne is a wonderful voice, both on the dystopian and utopian side. From that point of view, I think he brought his utopian self on Wednesday rather than dystopian. From that end, he made a couple of big claims around the AI piece and so on, and spoke about the transformatory aspect of this, and virtually said to you, if you're not on the bus, you've missed the bus, and you're in a lot of trouble from that point of view. Do you share some similar views in that space? Are you, like, you've been around in the workforce for 20, 30 plus years, and the speed in which this is all transforming itself? How does that make you feel from day to day when you look at these things going, geez, the world just changing so rapidly?
Yeah, well, look, I haven't known him for a long time, and in a previous role, have utilised his skills presenting to clients for a number of years. So I'm always interested to hear his views, and he's one person that is extremely well read, very knowledgeable, and what's going on around the world, and is not scared to go out on a limb. I think it was about May or June, I think, last year. I went to a conference, and there was a number of international speakers talking about AI and how big this is going to be. And they were talking about exponential growth, and it's going to be bigger than anything you've seen before. So Jonathan just, to me, in his presentation, just reiterated that it's not going away. It's here to stay. And if you're not on, and as you said, Luke, if you're not on board, you've missed the boat. And for me, it's then looking at ways that we can make use of that in either day-to-day operations or in terms of our clients and investing money. And he's no different in regards to, without sort of giving specific stock picks, he's talked about, if you want to play in that space, then you've got to be buying the components that go into it. And that's generally the hardware or the conductors and things that go into it. It's the data storage and it's the energy. Generally, the three major areas. And as you said, there's particular companies that, if they're not doing it as good as their competition in the AI space, that producing a product, then effectively just because you're in the AI space doesn't mean that you're going to make money. There's going to be a lot of failures, and already has been. So it's an interesting one, and it's look, I always find him fascinating. Known him for a lot of years, and I could listen to him for hours, but I think they put him on at the end of the day just because most people would be asleep otherwise, but he can keep an audience entertained.
He definitely can, mate. He definitely can. And look, I'm glad you raised the componentry aspect of it. I think the thing that is abundantly clear is, whereas in the past, if you had a competitive advantage as a company and you came out with a product, you had a significant runway, and you had a competitive advantage. And that runway might have been 1 year, 2 years, 3 years before your competitors came up with an alternative or something close that was relative to what you were originally doing. In this world of AI today, however, that's out the window. Your competitive advantage is the idea, and it can be replaced within 3 hours by something which is smarter, better, and so on. So what it has done, it's caused a rethink, particularly around the software piece. It's caused a rethink, particularly around business models and so on. But I do your statement before around the componentry, I think there's a lot of merit in that. What are the things that go into building this stuff? It is the data centers, it is the energies, it is the it is the chips, it is all that sort of stuff. So that sort of stuff that you're looking at, you're kind of going, well, okay, there's the revenue flow from that, and that'll continue from that end. But I do think it is a space, and I know I speak to my kids from this point of view, and it's just like you're trying to remind them, going, hey guys, you're at the start of your careers. This is a bus you don't want to be sitting off. You want to be sitting on this bus. Are you going all in? That's always a question. But I guess from that point of view, I wouldn't be ignoring it, because I do think it's going to change the way we fundamentally operate, and I do think it's going to change the way the world fundamentally operates. But I do think, with all the benefits that it brings, it's also going to bring some pretty hardcore truths, in the sense that, when you start to look at the robots coming out of China and what they're doing, human beings, you're kind of going, where does the human being fit in all this? So it's going to be fascinating. Now, Mirko, just on a final thing, and mindful of time, investment community this week, that segued from the market summit thing. Portfolios have been holding up well. Markets have been very choppy from that point of view. We've seen some of the decisions made, protect us on the downside, which is the most important part. If we think about moving forwards, what were some of the key takeouts from investment com?
Yeah, look, investment committee, it was I thought a really good, robust discussion around portfolios. It for clients that aren't aware of how that we go about that, at least once on a quarter, and occasionally in between quarters, we get an opportunity to do a deep dive into our portfolios, actually have a look at what is working and what is not working. And we'd love to say that every decision that gets made in investment committee is on the money and is always 100% successful. Certainly not the case. So get an opportunity to sort of say, how are we going with our asset class allocations? How are we going with our fund manager selection, our investment selections? And it was actually good to see that some of the decisions that we had made, going back almost 12, 18 months ago, had actually played out the way we thought they would, which was good. And looking at, and speaking of again to that quality theme, that was definitely a flow through from ours. We really saw the benefit of the diversification in our portfolios, and making sure that we weren't too reliant on any one asset class. Very difficult to remove your home bias hat for Australian equities, particularly, which we've always sort of maintained, and we've been rewarded as such. But overall, we talked about all the sort of issues that we're seeing around the global economies, around global markets, and more importantly, being able to sort of think outside the square a little bit, and not just assume that the information that's being fed to us is actually accurate and is of the right nature, and actually having a good think about, okay, where are we sourcing our data from? Where else should we look for pertinent information? And from that perspective, I thought it was a good conversation. We've got a few action items. We're going to make some portfolio changes, and I think one of the research consultants that was on the call was a little bit taken aback, Luke, when you said to him, look, we're happy to have a look at using that manager, but unless we can eyeball this rock star out of Sydney and see him face to face, it won't be happening. And that's always been a bit of a mandate for the Innate Wealth team, to sort of say, unless we can actually meet with the portfolio manager that makes decisions and actually runs the money, not interested, because that's what our clients expect of us. So good investment committee, and I'm glad that we're on the right track. But as with most investment committees, there's a fair few action items we need to deal with now.
Yeah, absolutely. I think the thing that stuck to me, Mick, from the discussion yesterday was the notion of themes, and we spoke about themes, and usually themes can take anywhere between 3 to 7 years to play out. Probably that line of thinking probably needs to go out the window. Things are moving so rapidly at this moment in time that 3 to 7 years is just not it's not even a contemplation at the moment. Everything now is, and I don't think it comes down to real short-termism of month by month by month, but I do think, that 3 to 7 year lens of going, okay, we just put it out there. I think that's definitely coming in there to a shorter lens. Somewhere between 2 to 4 years is probably more a realistic view, I think, from that point.
Yeah. Look, I 100% concur, and one of the themes that I thought was was quite interesting was perhaps maybe not demise, the decline of the US dollar and its strength and the ramifications for that around the world. And we've seen what, say, gold has done, and we've seen what the opportunity set out of the emerging markets is as a result of that as well, which we've always had a bit of a tilt towards in our international exposure. So no, plenty to unpick there.
Yeah, but also let's remember, a cheap US dollar means cheap US products. Yeah, so that's how this thing works. So you can see what they're trying to do from that end. Gentlemen, fascinating discussion as always. Really enjoyed it. Love seeing you both on the screen in the morning. Weekend coming up, last day of February, first day of March. There we go on Sunday as well. So what's the plan for the weekend, Anthony? You got anything exciting?
Doing something that I can't remember doing for a long, long time, and that's we're playing a game of bowls with 3 generations in the one side.
Oh, fantastic! Enjoy.
So going back home and Creswick and playing with my dad, my wife, and my daughter. So.
Oh, how nice!
Enjoy that weekend. That'll be fun. What about you, Mickey? What have you got planned, mate?
Interesting one. Off to Sydney late this afternoon. I've been invited to a charity event tonight, which is close to our hearts. So looking forward to doing that. That should be a bit of fun. And on Sunday, the Matildas are playing on Sunday, the first game of the Asian Cup. So. I believe the girls have got the Philippines in round 1 on Sunday night, so I'll be sitting down to watch that. That's for sure.
Good stuff. Well, I know from our point of view, a quick shout out to the guys from the Jacob Foundation. They've got their annual golf game on Sunday, and they've been doing an amazing job for the Royal Children's Hospital over 20 plus years. It's been extraordinary. I think 25, 26 years now. Actually,
over $1 million raised.
Yeah, over $1 million raised, and Innate has been a very proud supporter of that fundraising crew. And to Lou and Anna and the family, credit to you guys. That is just extraordinary what you do. Also, I'm also going to a wedding on Saturday, so to Marco and Nina, a massive shout out. To see a young couple so desperately in love as those two, and having as much fun as they are, is always cool. So it's going to be a cracking wedding on Saturday. So looking forward to that as well. All right, to our wonderful clients out there, I believe the weekend is going to be good out there from a weather point of view. End of the month, start of a new. Enjoy yourself, be safe on the roads, take care, have a drink or two, read a bit of the paper from time to time from that end. Gentlemen, thank you. To our team as well, thank you as well. And we'll see you all next week. Cheers, guys.
Cheers, Luke.
See you guys.